and it's a really super panel that we've got here. We've got Alan Dalgleish, Managing Director of Asian Property Intelligence, Natalie Breen, Partner Global Real Estate Legal Leader for PwC, and Terence Tang, who's Managing Director for Capital Markets and Investment Services for Colliers International, based out of Singapore. Alan, welcome, and thanks very much for hosting this session with us. Over to you.
Thanks very much for the kind introduction. I'm glad we got through the technology there. It's a pleasure to be on this conversation and with such old friends and industry colleagues, Terence and Natalie. Shall we get things started in the traditional way? Natalie and Terence, would you like to introduce yourselves and tell us what you do and your roles?
Sure. I might. Thanks, Alan and Terence and Richard. And yes, it's nice to be presenting with both of you, who I know very well from my days in Asia. I'm based in London at PwC, and I lead our Asia real estate desk here. I also lead up our global real estate legal and UK real estate legal business. So it's a pleasure to be on the session today, and I look forward to our discussion. Thank you.
Thanks, Natalie.
Thanks, Alan. Thanks, Natalie and Richard. I'm Terence Tang. I run the capital markets and investment services business in Asia. Works with all our different teams in Asia, and we are an integrated platform where we helps our multi-markets clients with their real estate investment needs in the region. I do work closely with our European colleagues and our American colleagues as well with cross-border investment. Thank you.
Fantastic. Thanks, Terence. And a quick word on me. I think many of you on the call might know me as previously as the Chief Executive of ANREV, the Asian equivalent of INREV in Europe, not-for-profit real estate association. I now run my own business, and we offer strategic research, consulting, and business development support to businesses in the real estate industry. So that is me. Let's get the conversation started, and perhaps by way of introduction, I think it's maybe something of an understatement to say that 2020 has been so far quite unprecedented and quite an extraordinary year, full of challenges and at times really deeply unpleasant. But it was Winston Churchill who said, never let a good crisis go to waste. And I think crisis, at least as it relates to real estate, can often mean dislocation, but it can mean opportunity. And I think that's what we're going to try and drill into today. So perhaps if we just start with what we are seeing in the markets. Natalie, can I throw it over to you to give a perspective?
Sure. So as I mentioned before, I'm based in London and kind of cover UK and Europe and have a real focus on inbound Asian capital, which has obviously been a huge interest in UK and Europe over the last few years from Asian capital. And I think there's still a real desire to deploy capital here from Asian investors into both UK and continental Europe. But of course, as Alan obviously said, COVID is putting a bit of a pause on that. And I think really what that comes down to is a bit of the mobilization issues. So the ability to actually travel and inspect properties, carry out physical due diligence, etc., obviously does impede somewhat transacting over here for some of these investors. But, a number of the larger Asian investors also now have local offices here. So those investors are able to transact. And also, I think there's probably a desire of sellers who want to be able to deal with face-to-face with their, prospective buyers, etc. So I think, having a local office here is key. And I think until kind of some of these travel restrictions start to ease up a bit, it probably we'll still see the pause. And I think also just where the various sectors are going, also there's a bit of a wait and see on some particular sectors as well, which we'll get into later, I assume, as well. I think the other thing we're seeing here in the UK market, and for those who've been following it closely, we've seen a lot of government financial support and packages to prop up the economy. We've also seen measures that are brought in to actually protect tenants, offering moratoriums of rent. Now, we've had that in place for 2 quarters, And yesterday, the UK government just announced for England that, again, that moratorium will be extended until the end of 2020. So that prevents landlords from enforcing evictions and statutory demands, etc., on tenants for non-payment of rent. So we're also starting to see basically a reset of the landlord-tenant relationship as well, and a much more there's much more impetus on tenants and landlords to work together to try and create and build value, because in these kind of quite trying times. So a lot of our time at the moment is spent on restructuring leases, a lot of focus on converting some of these leases to turnover rent and those kind of things. Which so we're seeing a bit of a shift there in the market on how these kind of lease transactions will be structured going forward. I might pause there, Alan, as part of an intro.
Yeah, no, that's really interesting stuff. I mean, would you characterise whether the support from the banks or from the landlords themselves, would you say that they're fairly sympathetic to the needs of their tenants? And
yeah, look, I think from the landlord's perspective, just as a general observation, there are obviously sectors like hospitality and retail that have been really affected by COVID with lockdowns and restrictions on trade, etc. But I think there are some perception of some tenants who can actually afford the rent, potentially taking an opportunistic perspective and taking advantage of some of this relief measure. I think on the banks, what we've got here is this is not a GFC 2007, 2008 event. This is really kind of a black swan event that's happened, which was no one's fault. And there's been a huge government stimulus packages offered, not just in the UK, but across Europe. And I think there's a kind of reluctance from banks to really enforce or go hard on these groups. There's a lot of kind of working with their mortgage with their customers, trying to sort out kind of an acceptable arrangement that works to get them through this period. So I think certainly banks are focused on their existing book of clients rather than kind of new clients. And we're starting to see like non-bank lenders becoming more prevalent in the market at the moment.
Interesting. I don't know if either of you tuned in on to the couple of the previous sessions, but Jason Oram at Europa made the point a little while ago. This is a consumer crunch, not a credit crunch. It's not like the GFC, so it's quite a different scenario, and the capitalization of the industry is pretty solid. So I'm guessing that's providing a lot of support.
Exactly, and to picking up that point, I mean, the stress that we're seeing are really in particular sectors, as you can imagine. I mean, retail, which is really probably an acceleration of a trend that was already occurring, but we've seen that accelerate. And also hospitality and leisure, where these restrictions have really impacted the ability to travel and stay at hotels and things like that.
Yeah. And Terence, we're just on the mobility side, and again, Jason referred to that. It's very frustrating when it comes to doing due diligence. I think you were, when we talked earlier in the week, you were talking about investors having to seek some local support in order to get deals done in certain markets. That's something you've seen.
Definitely. I mean, of course, real estate will involve the touch and feel. Given this is a substantial investment for an institution or individual, it's always good for the person to really go down, unless the investors have very good knowledge of the market or the surrounding of the real estate. So recently we saw a deal being done in Melbourne by Singapore-based investors, and without going down to visit the property, they were able to close the deal. And that's mainly because the investors was educated in the city, knows the city, but those are the exceptions. I think given brick and mortar, we will still require the touch and feel, when people make the investment.
Yeah. And would you say, Terence, the interest, there's been, let's say, a focus of interest in core, and perhaps not to put it as a flight to safety, but people are looking closely at what core, the definition of core.
I think this COVID, well, before COVID, I think there's so much liquidity in the market that a lot of the capital were chasing yields to the extent that, that they discounted a lot of the risk premium. The pricing of risk premium to come down to almost zero in some cases. So you actually see hotels transactions, retail mall transactions, and the offers and the core property transaction at a yield which is very similar. So I always say that over the last 10 years, we see yield compressed down to an equilibrium of 3 to 4%, regardless where the cities are, because that's where the insurance capital is get their comfort. But with this COVID, I think investors start to understand and realize that there is this thing called risk. So valuation of risk premiums now start to change. People start to really price the risk premium properly. So we are seeing the spread between yields for the different assets starting to widen a lot. So investors are now become a lot more wary about tenants, credential, the land of the will, the covenants, the banking covenants, and the market fundamentals. So capital today is definitely a lot more careful. But because of the uncertainties created by this pandemic, that investors would want to put more weightage on rental income, security of that rental income, rather than capital value growth. So that's why we see a lot more demand for core real estate with good tenants credential and in place, good covenant in place with the tenancy. That's the reason. I think it will take a while before the investors will start to go up the risk curve to take more risk and putting a lot more weightage on the capital, the capital appreciation piece, Yeah,
so this, again, linking back to the earlier two presentations, we're picking up things that have been discussed there. And David Riley, I scribbled some notes. David Riley at Blue Bay this is quite interesting, the impact of quantitative easing, and this, in the current market, a tsunami of central bank liquidity. And that immediately made me think of the GFC, and we had that same tsunami in a sense, although probably a smaller tsunami. And a lot of that went straight into real estate, I think. Not always in a good way. I think it puffed up some residential markets more than they should have been. But the fact is, you've got QE impact, low policy rates through to 2023 and beyond. And this was an interesting one. He said 6% of the global bond universe is only yielding 3% or higher, and 25% are actually negative nominal yields. So you have to look at property and think, well, I can get some positive returns. Obviously, as you said, Terence, being selective.
This is interesting. We are, I think that's the reason why we are seeing a lot of institutions are now putting a greater weightage on allocation to real estate. Some of the institutions are taking this opportunity to increase their weightage allocation to real estate from as low as 5% and trying to go up to 10%. And they are actively looking to place out capital. But the challenge that we have is how do you price the risk? So in terms of bonds, is the risk element is a lot more straightforward. Today, the government bonds is traded at a lot more lower yield than corporate bonds, right? So corporate bonds, because you have the corporate risk. Government is, the risk is definitely a lot more lower. So real estate is the same thing. I think the better managed government, the better managed cities, real estate markets, the more interest they'll see, and the expectation of yield in this market will be a lot lower because of the stability and lower risk that they offer.
Yeah. I mean, in terms of perhaps Terence just talking about geographies in Asia, thinking back to my ANREV days, a lot of ANREV members on the inbound side would, when you really got them to focus, they were looking at Japan and Australia. What's happening in the current market?
Right. If you look at the investment activities across the region for the first half of this year, there's a drop of 39% or so in terms of investment volume. But cities like Sydney and Tokyo, and even Seoul, we are still seeing substantial volume in these markets. I think basically these markets are very deep and broad market. The Tokyo and the Sydney and the Australian cities are offering a lot more options, a lot more depth in the real estate market as compared to the other markets in Asia. So if you look at the activities across Asia over the last 6 months, these two markets are still among the top 5 cities that investors are still very active with. Yeah.
Okay.
So,
and in terms of sectors, the darlings of the investment community at the moment seem to be data centers and logistics. As I was just looking at some headlines, there's a whole host of news recently from Mapletree, Gore, Blackstone, Keppel, and all the rest. I mean, what's that? Is that a sector you've been active in yourself? How are valuations looking? Are there still deals to be done?
Yeah. This crisis has changed a lot of our lifestyle. So as you said earlier, it is a consumer crisis. So the consumers has changed the way they behave. So digital transformation in how we work, how we live is happening throughout all aspects. So with that, there's a huge demand for data centers because of the demand of the space that they require, and with e-commerce coming into our life in a big way. E-commerce is now getting into the retail space, and with the logistic demand, the last mile demand with the e-commerce requirement, it is also we are also looking at a lot of unprecedented demand for that space. So it's happening across all markets. If we saw recently, GIC has gone into a major JV with one of the Equinix to put $1 billion into the Japan market for data center. And in China, we are also seeing the government very quickly relaxing the regulations surrounding the data center development. And right now, we are seeing every city, there are many data centers is being built. And sometimes we are worried about oversupply. But of course, there's some form of power requirement, the regulation that we have to meet. But definitely these two, logistic and data center, are growing by leaps and bounds in terms of demand across all markets in Asia.
Yeah.
And I'd probably, I was just going to say, I'd probably support that as well over here. I mean, logistics has been really in demand, data centers as well, but I'm actually going to say science parks, affordable housing, senior living, some of these sectors which are seen as much more resilient going forward. I also think, there are groups looking at distressed opportunities, but distress is really going to be around these COVID impacted sectors like retail and leisure and hospitality more so than other sectors.
Mm-hmm. And again, picking up on one of the earlier conversations, there was a bit of debate around whether it was too early to report the death of the office sector. And I think the feeling was that...
I'm in the office now. You can see quite a few people in behind me, actually. I'm in Bateman Place at the moment. Central London. Actually, interestingly, we've been one of the first of the big four to go back to our offices. We went back in July, and obviously people are encouraged to come in, but you don't have to come in. But I think there's something to be said about the things that you can't get from these calls and Zoom calls, etc. And that's the kind of team collaboration. I've got some of my team in today. It's kind of innovation and, also the kind of fostering of learning and development, which, it just doesn't happen always over a video call. So there's definitely benefits for it. And I think if you pick up a paper in London any morning, there's like commentary on, what is the future of the office. And I think the reality is no one knows yet. I think time will tell. We have seen, probably there are some existing occupiers who are reducing their space, but, we don't really know, is that a result of a kind of immediate cost-saving thing, or is this actually a structural shift? So I think kind of the jury's out yet, and time will tell, what that looks like. But I think one thing that is going to be here to stay is flexi work, and I think, everyone's been able to work productively from home, but that's not the only solution. So I think it's going to be a combination of working from home and the office. That's my personal view, but we'll have to wait and see, I suppose. It's good to see what Terence thinks about that as well.
Yeah, no, we take a view that the office space is definitely very much needed and will continue to be in demand. It will still be a place for collaboration, to build a company culture, and where you can brainstorm, unlike being working from home, staring at a computer screen. It's very hard to be interactive enough to exchange ideas. So I think the key word is flexibility, adaptability. Office space has to become a lot more flexible and adaptable for changing needs. And more and more office space will become a lot more emphasis will be on office space to become a collaboration point. So there will be more meeting rooms, there will be more video conferencing equipment, there will be more modular furniture where you can mix around with teams. This before COVID, the entire office environment was moving towards the hot desking area and the co-working space. I think it will be brought back to somewhere in between. There will still be some form of hot desking. There will still be flexible workspace required. There will be a combination of core and flex requirement by tenants. Flex to the extent that allowing 10% or 20% of staff from working from home. 10 or 20% of the staff can work from home. And at the same time, you will have more satellite offices where you allow different needs of the staff. I think there will be a lot more flexibility in terms of how a company will organize its office needs. But the emphasis will then be more of collaboration rather than just need everyone at the same place.
Yeah, agree with all of the above. I mean, just one angle is young professionals. If you have new joiners coming to the company, very difficult to imbue them with the corporate culture and to get to meet people and know people. Whereas if you've been part of the furniture for 10 years, then you can do that very easily. And clearly working from home is not ideal. My golden retriever burst into the room on a call yesterday, which is very amusing for everybody, but I've, needless to say, shut the door rather firmly today so that doesn't happen.
And the other point, Alan, as well, I mean, a lot of companies have gone to a lot of effort to make their premises COVID secure. Like, I mean, if we come into our office, we've got, it's all been mapped out where you can sit, etc. There's sanitation, sanitizer everywhere, and actually we've got a really good system of booking desks, etc. But I think, a lot of employers have really gone out, done everything they can to make these premises safe for their employees to come back. I think, part of the issue and reluctance to come back is obviously the transport and how you get here. And I think a lot of people feel secure coming to the office, but if they have to get a long train ride, then maybe that kind of sways their decision. So there's a lot of factors that go into it. and also what's happening in the environment, if there, is there going to be a second wave, that kind of thing, which, we don't know. So, but, I've enjoyed coming back a few days. I come back probably 1 to 2 days a week, and it's been rewarding from my perspective.
Good.
Yeah, a lot of our clients are just telling me that they really can't wait to get back to the office, to enjoy the brainstorming and the collaboration work. But the other thing is that this COVID has also start to let us think about how should we actually maintain and manage our building to ensure a safe environment, right? So I think the authorities in the different government will start to introduce new regulation, new requirement in terms of having a safer, more hygiene standard within the building. In the past we heard about this sick building syndrome. It was a problem, but it didn't go away. Some people just close one eye on it, but I think it become a lot more serious. Authorities will have to address this. So cost of building office building will go up. Cost of maintaining an office building will go up. Asset management will be a lot more stringent in terms of making sure that the access points as well. The access point will be a lot more stringent in terms of having less access points than more access points. So some of these things will change, and it may become a habit. But people have short-term memory, so hopefully unless the authorities put it as a requirement, as a policy requirement, if not, it's very easy for people to forget as well.
Yeah, but I think behaviours. I think some behaviours that we're seeing now are probably going to be fairly permanent. Certainly, I'd again referring back to some of the earlier panels, the notion of paying close attention to risk management, and that can be credit risk to your income, and looking at the credit worthiness of your tenants. But can also be, how safe is the building? So I think there'll be a lot, as you say, a lot of attention will be paid to that in future.
And I think, Alan, that's picking up that point. The role of the asset manager is going to be really important, and I think that's going to be where a lot of the value going forward is going to be extracted from. Is how well is your building getting managed for all the reasons that you just said then. So I think there's going to be a lot of focus on management of your building in a safe way.
ESG will become an important element in a lot of the checklists. So we are seeing some investors insist those boxes have to be ticked as well. And even the tenants that those are some of the must-have before they agree to take up a space in the building.
And actually, green leasing, touching on ESG, a lot of tenants now require green leasing clauses in their leases, and we've seen a real huge emergence of that in continental Europe. They're very advanced on their green leasing. A lot of the main countries there, like Germany and France, etc. And here in the UK, we're starting to see an increased focus. So I think tenants are going to be wanting landlords to respond to the ESG, the green leasing, and also obviously making the environment safe.
Perhaps just changing tack slightly, coming back to transactions and the nature of transactions. As you said, Terence, the volume of deals in APAC is way down. But as I prepared for this call, I was having a look at a few news headlines, and if you sort of try to forget about COVID, you would look at the headlines and think, well, there's a bunch of deals being done. It all looks quite normal. But would you say that there's a bit more of a focus on long-term commitments and sort of, shall we say, extension of a partnership type deals than the new deals? I mean, presumably sentiment is pretty fragile right now, right, for new deals?
It is for certain institutions, if they come up with new strategy or new deals, they would need to be able to sell the story to the investment committee. So you will need to do a lot more underwriting or convincing underwriting to go into a new deal or a new strategy. But we talk about data center and logistics. That story is a lot easier to sell than before. I mean, than a new story, unless if it's a partnership and taking a longer term view with a existing partner that you have. But that will probably be a easier sell as well to do that. But the thing is that, like, for investment into office space, there are still some concern as to how the demand for office will change. How is it going to compete with business park? How the differential in terms of cap rates between suburban office and the CBD office, between a business park and a CBD office. So I think even if someone is to take a long-term view, unless the asset is a very prime asset that, usually you don't see this sort of assets out in the market, and only in a crisis that you see for sale. And then so people will then take, will then take a serious look at that investment. If it's a average investment, it will take a lot of, even for a long term, it will need a lot of convincing to make that investment. Yeah. So even if it's long term, it has to be very prime, and it is almost like once a decade opportunity that you will then embark onto. If not, then people like to see more clarity with the investment environment before they make the commitment. Yeah.
Mm-hmm. And just talking about one particular deal I happened to see actually in Singapore, a manager bought a industrial building, and partly on a sale and leaseback basis from an industrialist. And so I had the impression that some liquidity was being released. Is that a feature of the market? I think, Natalie, you commented that was the case in Europe.
Yeah, I mean, we are seeing groups who have kind of surplus facilities on their balance sheet look to do a sale and lease back for a number of reasons. One, I think, there's a lot of clients or a lot of groups that are looking strategically at their business, and they're coming to the conclusion that actually, well, we don't really need that surplus site, and actually we're better off taking a lease back on it. There are IFRS 16 considerations as part of that, which also would be part of their analysis. But I think we are seeing a few sale and lease backs coming to the market as a way to kind of release capital. Also from a strategic perspective, it's the right thing for that business to do. So I think that will be a trend we'll continue to see, actually.
Yeah.
I think for some of these core assets or portfolio that will, which in normal time will give some income stability to return. The investor will require sales and leaseback to at least give them the comfort of going through this couple of years of uncertainty. Because the uncertainty for this sort of investment is only in the next 2-3 years. So they're prepared to take a longer term view, in some of these stabilized core assets. Usually these are the industrial or suburban offices and not the prime assets. But they will still have some, uncertain income flow over the next couple of years. So they will require this sales and leaseback requirement just to tie through this couple of period of difficulties.
Yeah. Now the countdown clock seems to have disappeared somewhere, but Richard, I think we've got about 5 minutes. Is that right? Yeah, Richard's nodding. I can see Richard nodding. So, I mean, perhaps just summing up, I've just scribbled a few notes. So what we've talked about are Natalie, I guess, firefighting activities as leases have been restructured. Participants are looking at innovative ways to get deals done in the market. Perhaps we can't say there's no distress. There's certainly some people are experiencing pain, but banks seem to be pretty sympathetic. and potential investors are pretty well capitalized with dry powder, and actively looking for opportunities. And we talked about core assets and the better governed markets as good defensive plays. Is there anything you guys would add to that to conclude?
Yeah. I think on distress, there's obviously distress in the retail sector and F&B here. I mean, we've seen numbers of groups do a CVA, which is a precursor to administration restructuring. I've also seen one of the biggest groups here, Shopping Centre REIT, go into administration. So I think there is distress around the sectors that are most heavily impacted by COVID. So retail, F&B, also obviously travel and leisure sector. And I think in relation to, we have to see how it all works for the banks, because obviously as the period of COVID goes on and gets more protracted, then things become, I suppose, more fragile. So I think it's a bit of a wait and see, but certainly to date, we understand, what we've seen is banks are fairly sympathetic, but, we've just seen this moratorium in England for commercial tenants on rent relief be extended to the end of the year. So that means landlords have not been paid, in some instances, depending on their tenant profile, rent for 3 quarters. So ultimately, it's all going to start to have a bit of an impact because they've also got their own obligations, they've got shareholders, etc. So I think we need to wait and see and how this pans out, really.
Okay, agree.
Yeah, but Adam, maybe I can add is that now for Asian investors, which I didn't talk about earlier, they are like any other global investors. They are looking at opportunities across the group, which will meet some of their needs. So in Asia, most of the markets do not offer some form of a stability or longer term growth, longer term secure income as what the European markets can offer them. So we are still seeing a lot of interest from the Asian investors, whether they are Singapore-based, Japanese investors, the Hong Kong investors. They are still keen onto looking at outside of Asia to look for investment that can offer them a longer-term stable return. Because in Asia, I think they are looking more for capital growth, capital appreciation growth. But in the European markets, they're looking for more secure, safe haven sort of returns. So as investors, they have different pool of capital that they want to place in, and they are becoming more and more global. So the Koreans are still very keen in the European markets as well as US market, because they give them a different risk return as investing back home. But interestingly, this COVID pushed a lot of the Korean capital to spend more time and deploy more capital back in their home than outside of Korea.
And actually, just picking up on Terence's point, I think there is different speeds that different countries are recovering at the moment. So that's also going to impact allocation, I would have thought, as well, depending on how quickly the particular jurisdiction's recovering from the pandemic. So if you look at continental Europe, like Germany, I understand from my German colleagues, is really kind of, I wouldn't say back to normal, but it's, there's a lot of activity, maybe not quite the pre-COVID levels, but it's kind of recovered faster than, say, the UK, and that's probably reflective of the fact it kind of got hit first. So I think different governments and different responses will produce different speeds of recovery as well, which will probably influence where some of this capital goes, or the timing of it.
Agree. Yeah, well, I think we've got some ups and downs still to go, but whatever normal becomes, I think we're all looking forward to whatever that is.